So when big company purchased 20% of little companies' common stocks, big company paid $210,000. How was this number determined? If I want to buy a company, I would want to look at the company's assets, liabilities, and then assets minus liabilities equal owner's equity, or net assets. Yes? Net assets. Now, we know that the assets, we have cash, we have account receivable, we have not receivable, we have building, equipment, land, some intangible assets. So some of the assets are valued at historical cost, and some of the assets are valued at book value. And for example, equipment's book value is the historical cost minus accumulated depreciation. And the land is valued at the historical cost, and there's no depreciation for land. We think of inventory. Inventory is valued using LIFO or FIFO, for example. So this is the net assets. If the assets is 100K and the liability is 60,000K, then net assets or stockholders' equity is 40,000K. Then I should pay 40,000K. But does this really happen? Do I pay only 40,000K? The answer is no. Usually you don't pay the book value of the net assets. You pay the fair market value of the net assets. All right? So why the fair market value is usually, most of the time, higher than the book value of the net assets? Well, the land that is one asset and the equipment another asset, and maybe other type of assets, maybe has a value that is larger than the book value. And that is a reason why the investor may pay more than $40,000, okay, to acquire this company, because the company has some of its assets that their current value is larger than the value in the books. So I'm going to pay more. All right? And that's called, like the building, the land, the inventory is called the identifiable asset. It's called an identifiable asset. All right? Now, sometimes I pay more, but the excess over the 40,000 is not because of appreciation in assets, but because I feel that this is a great opportunity. The investor and the investee together are going to do amazing things, and that is called goodwill. All right? We pay more for goodwill. So let's look at this question here. Grande Company is negotiating the acquisition of 30% of the outstanding shares of Chico. So Grande is the investor, wants to purchase 30% of Chico's outstanding shares. 30% should be a reminder that you need to use the equity method. Chico's balance sheet reports assets. So the assets, maybe I wrote this down, let's see. I did not. No, I did here. Grande to purchase 30% of Chico's assets. Okay. And Grande wants to pay $90,000 for the 30%. Now, the question is telling us on the date of purchase, Chico's assets were valued at Chico's asset. Okay, I just said were valued at 500. I have to be careful here. That's the book value. Chico's assets book value is 500 and liabilities 300. Net assets is $200,000. So in the assets, we have inventory, we have equipment, we have land, building, etc. You know, after investigation, Grande determines that Chico's equipment is undervalued in the company's records by 60,000. So there's an equipment here, okay? Let's just assume it's 100K. It's actually undervalued and should be 160,000. So an equipment appreciated in value by 60,000, but in the books of Chico's, it appears at a book value that is 60,000 less than what it should be. So when I'm going to buy this company, Chico is going to say, hey, you can't pay me this is the net assets, and I want to own 30. You can't pay me $60,000. You should pay me more because there is an asset here, an equipment that is 60,000 more. Okay? And this is a 60,000. And if I want to buy this asset, this company, then I need to pay an additional 18,000 on top of the 60,000. Then Grande discovered that patent was appreciated by 40,000, and my share of that is 12,000. So guess what? I can't pay just 60,000. Again, the 60,000 is 30% of the net assets of the investee, but that's based on the book value provided. But now we learn that there is an asset here that is understated. There is a patent here that is understated, okay? The value has been appreciated by 60,000 and 40,000. If I want to own 30% of this company, then I need to pay 30% of the 30% of the appreciated price. So 60,000 is not good. I should pay 60,000 plus 18,000 plus 12,000, and that's the 90,000. Where is it? Grande offers 90,000 for a 30% share of the outstanding stocks of Chico's. All right. So again, I want to buy 30% of Chico, and 30% of Chico is 60,000. But then Chico said, well, the equipment per market value is 60,000 more than what it's reported in the books. There is a patent that is 40,000 more than what is in the book, so that's 100,000. So I'll say, well, 30% of that 100,000 is $30,000. I'll pay you in addition to the 60,000, the 30,000, and that's a $90,000. So how much the investor is paying? 90,000. What is the percentage of book value acquired? The net assets is 200,000 times 30% is 60. Well, you are paying $90,000 for 30% of the company's net assets, which is 60,000. Why are you paying 30,000 extra? Well, the 30,000 extra, 18,000 is for the appreciation of the equipment, and 12,000 is for the appreciation of the patent. Okay, so that explains why I'm paying 30,000 extra. Okay. What if I paid here 100,000, not 90? Then 100 minus 60 is 40. And 30 of the 40 is going for these identifiable assets. There is 10,000 here extra. This 10,000 extra that is not assigned to any identifiable asset is considered goodwill. Okay, so here's the example here. Assume that 90,000 is not a good deal, and Chico said, I want $125,000. So we paid Chico 125,000, and the book value of the company's net assets is only 60. Again, how did we find this? Assets minus liabilities is stockholders' equity or net assets, and I want 30% of that. That's the 60,000, but that's only the book value. Okay, well, why did you pay 125 if the book value of this company, the net worth on the books is only 60,000? Why you paid 65,000 more? Well, the value of the equipment increased by 60,000. 30% of that is 18. Patent increased by 40,000. 30% of that is 12,000. So I, Grande, the investor, has to pay for this. 30,000. I have to pay 30,000. Okay. Payment in excess of book value is 65 minus, these are justified payments. You understand? Again, these are called identifiable assets. But there's 35,000 still excess payment not identified with specific assets. This is called goodwill. Okay, so let's read what I highlighted here. As this example indicates, an extra payment that cannot be attributed to a specific asset or a liability is assigned to intangible asset goodwill, although the actual purchase price can be computed by a number of different techniques or simply result from negotiations. Goodwill is always the excess amount not allocated to identifiable assets. Under the equity method, the investor enters total cost in a single investment account, which means I'm going to debit $125,000, okay? You're not going to break this down to equipment, patent, and goodwill. You'll debit 125,000 and for investment in Chico's and credit cash. This is only under the equity method. If all parties accept Grande's bid of 125, the acquisition is initially recorded at the amount despite the internal assignment made to equipment, patent, and goodwill. The entire 125 was paid to acquire investment, and therefore it will be debit investment in Chico's 125 and credit cash 125. Okay, that's it for now. And see you later.